Hey guys, and welcome back to the channel. Today we are diving into a company that has just shocked the semiconductor world. That is right, it's Texas Instruments. Their data center revenue didn't just grow, it just exploded 90%. For a company known for analog chips, not AI accelerators, this is a huge shift. So we're going to be breaking it down. We're going to be walking through Texas's business model, the financials, the long-term strategy, and ultimately whether their stock is a buy, sell, or hold. By the end of this video, you'll understand that Texas Instruments better than 99% of other people that haven't watched this video. So let's dive into it. So Texas Instruments Incorporated, they are engaged in design and manufacturers of semiconductors. It operates through the following segments: analog, embedded processing, and others. The analog segment, semiconductors change real world signals such as sound, temperature, pressures, or images. And then the embedded processing segment involves handling specific tasks and can be optimized for various combinations of performance, power, and costs. Now, at the time of recording, you can see that it's jumped up by 20% on the day. And as you can see, year to date is up by 61%. The price is at $282. It's based in the United States. It's an electric technology company with semiconductors with a market cap of 256 billion. And it IPO'd in 1953. And the best thing about it, the dividend has been growing for 22 years with a growth rate of 4.46%, with a dividend yield at 2%. So the whole reason why this is quite a good company and why they have two business segments, because analog chips convert into physical signals, like we have gathered, which gives Texas the long product life cycles, high switching costs, predictable demand, and of course that helps the 22 years dividend growth streak. This company is built for durability, not hype. So, despite the stock price growing, why has net income fallen? Well, this is what's confusing a lot of people. The stock price is rising massively, but the net income is falling. So is that a red flag? Well, not necessarily. The stock market prices future expectations, but not past earnings. Texas is currently in a semiconductor down cycle. Industrial demand softened, automotive customers corrected inventory, and depreciation from new fabs is temporarily weighing in on profits. These are normal cycle dynamics, not signs of broken businesses. But the market is looking ahead. The 90% surge in the data center revenue is a signal that demand is reaccelerating in one of the most important growth areas of the entire semiconductor industry. So even though net income is down today, investors are pricing in recovery. So sales have fallen off the peak high as well. So they have come down from the peak of 2023. So this is the thing with semiconductors. They move in waves. They boom, inventory builds, slow down, recovery. And Texan is in its slowdown phase. But here's a deeper point. It's investing heavily during this downturn, building new fabs, expanding the capacity, which we'll get to, and strengthening their manufacturing advantage. This is like planting seeds in the winter and the harvest comes when the cycle turns. The question isn't why sales falling. The real question should be, what position will Texan be in when sales recover? And the answer is a very strong one. But dividends have grown at a strong rate too. So this is where Texan stands out. Even during the downturns, they continue to raise their dividends because their business model generates consistent free cash flow, even in weak years. Analog chips have incredibly long life cycles, sometimes 10, 15, even 20 years. Once a chip is designed into a product, it stays there for the entire lifespan of that product. This creates recurring revenue streams that don't disappear when the economy slows. Texan's 22-year dividend growth streak tells you something more important. The management only raises a dividend when they're confident they can stay in it. And this is why dividend investors love Texan, because it's a compounding machine. So, how can they do it? Well, we briefly mentioned about the analog and the embedded processing. Analog is the foundation of the company. These chips convert real-world signals into digital data, like they are used in cars, factories, medical devices, energy systems, and consumer electronics. Analog chips don't need cutting-edge technology. They need reliability and long-term availability. This gives Texan extremely long products, life cycles, high switching costs, low risks, and stable demand across hundreds of industries. Analog makes up roughly 3/4 of the revenue. It's the steady, predictable engine that funds everything else. And then we get onto the processing, the intelligent layer, and the brains inside the machines.
These chips help machines make decisions, controlling the motors, managing the sensors, and running software. They are used in the industry automation, robotics, smart energy, aerospace and defense, and automotive electronics. Embedded chips often get paired with the analog chips, so when a customer chooses Texan for the embedded processing, they frequently choose Texan for analog as well. This creates a multi-chip ecosystem that locks in customers for years. So they have just recently brought out their management investor presentation. So we are going to go through this now. So as you can see, we've got a little bit of a summary from the management themselves. So this captures the entire philosophy of what they are trying to do at the company. And straight away, the first line, I love it. And I think every investor should love that too, because they are running the company like long-term owners. Now, if that said, oh, we run the company with mindset of being a short-term owner, then red flags will start alarming because they're not trying to see the long term. They just want short-term profit. But here they're like, well, it's going to take time. We're going to take time to make the profit, but make it really worth your while. And this is what I love because their primary goal is to grow free cash flow per share, the most important metric for a long-term shareholder value. Their strategy is built on 4 competitive advantages: manufacturing and technology, a broad product portfolio, deep customer relationships, and long-lived positions in essential industries. This company is built for compounding. And then, as we can see, the operating cash flow enables long-term investments. Even in a down cycle, they've generated 7.2 billion in operating cash flow. And instead of sitting on it, they've reinvested heavily. 4.6 billion in capex to expand capacity. This long-term thinking in action, they're building fabs today that will support revenue in the next 20 to 30 years. As these fabs near completion, capex will naturally fall, meaning more cash will be back to shareholders. And scalability is great because their new 300 fabs are being built in phases, modular, scalable, and aligned with demand. By 2026, over 90% of the wafers will be produced internally. By 2030, 80% will be on 300 wafers. This structural cost advantage that competitors simply cannot match. And this is why. Because chip cost is 40% less on the 300s. This is one of the most important slides that I think we all will be looking at today. Because the wafer produces more chips at a lower cost. Texan estimates the chip cost dropped from 0.2 to 0.12. There's a 40% reduction. This translates directly into higher gross margins, more free cash flow, more dividends, and more buybacks. This is why Texan is investing so aggressively that the payoff is enormous. And this is the execution of the capacity to support growth. As you can see, we can see multiple completes on there. They are doing ongoing on the LF Fab 2 clean room, but this is great. They're delivering their fab expansion on time, on budget, and high efficiency. In the semiconductor industry, this is extremely rare. Most companies run over budget or fall behind schedule. But this is the great thing about this company. Their execution gives them a massive competitive advantage because into the next cycle, they're going to be stronger than their competitors. And while they're doing this, they are delivering free cash flow per share. This is the payoff. As capex and revenue recovers, free cash flow per share is expected to rise sharply, approaching a long-term trend line by 2026. This is the moment Texan has been building towards. Their investment made today will drive shareholder returns for decades. And this is what I love, right? So we are at pretty much 2026 and we're pretty much halfway. So by the time 27 comes, it should be back to where it should be on the trend line. And they're on track to deliver more than $8 of free cash flow per share at the current 2026 revenue. So what was the main reason for the jump though yesterday? Well, the main reason for the jump is they jumped because analysts didn't expect Texan to show this level of strength in data center demand. A 90% surge is huge, especially for a company not known for AI exposure. Major banks upgraded the stock, raised price targets, and highlighted improving industrial demand. The market is now pricing a recovery, not just for Texan, but for the entire analog sector. And this is what I love,
because when people don't expect a company to pull off such a good result, everyone gets shocked, but the stock loves and the stock grows, and we all love growth. So, the main question is it to buy? Is it to sell? Is it to hold? Well, in the buy case, it's a data center revenue accelerator. Semiconductor cycle is bottoming. The cost advantage of the 300 wafers and the strong dividend growth is a good thing. Now, if you are already holding the company and want to ride the recovery, well, like you're already doing, up 60% to year to date, and earnings are still under pressure a little bit short term with the analysts expecting, then of course it's a hold case. But if you want high growth AI exposure, you dislike the multi-year capex cycles, and you prefer companies with accelerate earnings today, this will probably not be a company for you. But for me, this leans towards more a buy/hold. It's for long-term investors, and if you want a compounding machine, this is one that should be on your list, or already should be in your portfolio. So, I hope you guys did find this breakdown helpful. Make sure to follow the channel and for more deep dives, portfolio updates, and real investing education, not just hype. There's always videos, hopefully every week. So thank you for watching, and I'll see you on the next one. Bye.